This topic is about product design cycle.
Learning outcomes. Identify factors to be addressed and reasons to design insurance or financial products. Explain the product design cycle. Describe the concept of risk assessment and underwriting and developing insurance products. Factors to be addressed. 1. Key product features, define/specify circumstances, exclusions, and other special circumstances. 2. Managing the risk associated with the product. Insurer needs to assess the risk involved. How to manage the risk. Strategies to deal and manage the risk. 3. Choosing distribution channels. How the product will be distributed. Distribution channels. Agents, who represent the insurer. Brokers, who represent the customer. Bank assurance, where employees of a bank advise on insurance offered by a subsidiary. Direct marketing, advertising and media/direct mailing. Online sales, selling product over the internet. 4. Formulating market strategies. Determine target market. Potential customers' location. Socio-demographic. Construct an appropriate marketing mix, 4 Ps. Product specifications. For example, types, purpose, benefit. Price, set prices to cover the cost of marketing strategy, to meet profit objectives. Place, distribution channel. Promotion, media advertising, sponsorships. 5. Setting up the administration systems. Use current administration system/modify. Product development stage, costs, timing, staff. 6. Assessing capital requirements. Amounts of capital required. Why develop a new product? To match what competitors are currently producing. To break into a new market. Declining profitability from an existing product. A change in legislation, for example, taxation, Social Security, that creates new opportunities. An existing product nearing the end of its lifetime. New patterns of demand resulting from demographic changes. Technological developments, for example, internet, that make lower costs possible. Understand the need. Who will be our customers and why? The market may be new. Addressing a new need of an existing market. Responding to a changed need of an existing market. Where did the need originate? Technological advances may generate a brand new physical product for which insurance is required. New legislation may open up a new investment opportunity. New tax laws may make an investment more tax effective than before. Determine what has changed if there is existing need for which no suitable product, to make it possible to satisfy the need now. Why is this need not covered already? Maybe meeting the need was too expensive, too risky/too complicated. Before going ahead with a new product, understand and have allowed for the factors that ruled out the product in the past. Introduction. Product design control cycle. Stage 1. Identify the need for a new or modified product and develop a product strategy. Stage 2. Develop the product. Stage 3. Manufacture and distribute the product. Stage 4. Gather and monitor experience. The process of product design can be viewed as one step in the actuarial control cycle. Product design has its own cycle with 4 stages. The process forms a cycle as the 4th stage often leads to the identification of the need for a new or modified product. Can the need for a new or modified product be met? 1. Financial viability. Necessary price to meet all the costs and obligations. For example, many people have several products from a single bank, for example, check account, home mortgage loan, credit card, savings/investments product. 2. Affordability. For example, racing yacht is easily damaged when put under pressure and repairs are very expensive. Cost of the cover would be formidable due to the high frequency and severity of damage. 3. Timing. Some opportunities will remain open for short time only. For example, a time limit was placed on the tax incentives to encourage taxpayers to take out private health insurance quickly. 4. Legal requirements. Know and understand the requirements of all relevant legislation, regulations, professional standards and codes of conduct that have a bearing on the product. 5. Fortuitousness. Any occurrence of loss that is significantly dependent on the policyholder's behavior creates moral hazard/fraud. 6. Accessibility. Must be able to assess the expected cost of loss. 7. Independence of risks. In its simplest form, insurance works by the pooling of independent risk. 8. Criminal activity. A basic principle of insurance is that its availability must not threaten the public interest. Stage 1 of Product Design Control Cycle. Identify the need for a new or modified product and develop a product strategy. Innovation. Banking apps as a result of mobile technology. Derivatives designed to meet an unserved market need. Response to change in regulation or tax law changes. A change in regulation may create new market needs, new products or modification to existing products. Entry into a new market or distribution channel. If a company enters a new market or distribution channel, product design is necessary, as products intended for one market or channel will not always be suitable for another market or channel. Updating an existing product to reflect relevant experience. Update product to reflect experience. This experience may be related to consumers, economic environment or company expenses. Market research. Identifying a market need or confirming one exists. Confirms company has resources to meet the need. Identifies competitors and their products. Develop a product strategy. Discuss how product fits into company's strategic plan and current product portfolio. Discuss specific markets being targeted. Develop sales and profit expectations for the product. Distribution method. Competitive advantages of the company. Discuss resources necessary for a successful product and evaluate a company's capacity to meet those needs. Discuss risks associated with the product and the ability to mitigate them. Fit of product. A successful product must meet customer needs and be consistent with the capabilities and business plan of the product provider. Target markets. Is it pursuing a particular demographic? Does it want to fill a gap in its product range? Are its distributors giving preference to products of competitors or to products of a different kind? Is it directed at existing customers or at new ones? Will it be strongly differentiated from its competition, or will a significant selling feature be its price? Distribution method. Distribution channel for a product aspects the product design as well as the pricing and experience of the product. Product developed for a specific market need might be successful in one distribution channel and not in another. Egg. Financial products sold through direct sales must be simpler and easier to understand than products sold through agents. Agent is an intermediary and can explain the product to the consumer, which permits a more complicated product to be designed. Identify the resources required and available. When an insurance company issues a product, it will need capital to finance the initial costs until they are recouped from premiums and to absorb unexpected losses. So for every product there has to be some capital to support the product. Same with banks. Capital to support each mortgage loan, to absorb larger than expected losses from default. Riskier the product, larger the capital required. Regulators might also require high capital requirements. So a higher price need to be paid by the insured or lower profit for insurance company. Capital requirements encourage product designs that work around these issues.
Stage 2. Product Design Control Cycle. We are now at the stage of developing the product. In this section we discuss project management. Project management principles should be followed in most product design projects. Project management includes development of objectives and expectations for the project, financial implications of the project, which means before beginning any project, it is important to understand and articulate the objectives and expectations of the project. Timeline, responsibility, and communication. A major project is often overwhelming due to its size and scope. Project management takes the overall project and breaks it down into small tasks that are more manageable. Design features to control risks. Some resources that may mitigate risks and enable products to be sold that would otherwise be too risky for the provider. The next section is how the design product can affect the risks. Then competition, the marketplace and the pricing process. The pricing product cannot be done in a vacuum. You need to take account what is happening in the marketplace. The pricing process will also have regard to what your competitors are doing. Pricing must consider the cost of producing the product. Competition and the marketplace have a strong influence on product design. In designing a product for any industry, knowing the design of competing product is critical. Next is stakeholder expectations. In the product design process, the interests and expectations of the various stakeholders must be considered. Clearly, the provider designing the product and the potential consumer of the product will be stakeholders. In addition, they may be several other parties who have a direct and indirect interest in product, such as retailers, who will make a profit by selling the product, and the regulators who will be interested in the safety of the product. Lastly, deciding whether to launch product. The third stage involves the manufacture and distribution of the product. For financial products, There are generally 3 steps within this stage: distributing the product clients, risk selection, administration of the product, and also an institution that issues financial products will end up with both liabilities and assets. Potential customers have to move to buy the product. The first step of this process is to draft the contract and sales material. The second step is marketing it to the customers. The wording of contract specifies the agreement between parties to the contract. In the case of insurance, the insurance policy states the obligations of the company and the policyholder. The policy will state the exact circumstances under which the insurance company is obligated to make a payment. Actuaries as well as lawyers are generally involved in the writing of the insurance contract. Contract and sales need to specify the product in detail and define the circumstances that would lead to a valid claim, specify exclusions. This will affect the contract wording, pricing, marketing, promotion, underwriting, and reinsurance. If a company uses intermediaries, the type of intermediary will also influence product design and cost. They need to decide how the product will be marketed and distributed. Cost of marketing and distributing will affect the pricing. Marketing campaign will affect the volume of sales. Risk selection is a primary tool used to mitigate certain risks. Process that insurance companies and lenders use to differentiate between the risks that they're willing to accept or not. Additionally, risk selection is used to classify and determine the price for those risks that are accepted. The principles of risk classification is to ensure the continuous availability of a full range of risk-related products, which is compulsory insurance or non-compulsory insurance. Purpose of the risk classification: enhancing fairness. Individuals should pay a price that is fair in relation to their likelihood of loss. Maximizing the availability of insurance on individuals with high or low potential risk. Lower costs to lower risk individuals. Higher risk individuals take out cover at an appropriate cost. Protecting the insurer's financial soundness. Helps insurers to stay in business. Through risk selection, insurance companies are able to stratify risks so that similar risks are grouped together and charged the same premium. The stratification prevents excessive cross-subsidization between risk groups. For products in the financial services arena, once the product has been sold, the company must still administer the product. This is unlike most other products where once the product is sold, other than warranty or liability claims, the producing company no longer needs to worry about the product. For loans, administration includes sending notices of payments due on a periodic basis. This required to maintaining the current information about the customers. For insurance product, administration includes collection of premiums, payment of claims, maintaining current information on the policyholder, calculation and maintenance of reserves, and as well as many other functions. The establishment of appropriate administration systems is vital to the success of the new product. Current administration system may need little modification, extensive remodeling, and institutions that issues financial products will end up with both liabilities and assets. It is essential to have a strategy for asset liability management throughout the lifetime of the product from the very beginning of the product design process. For example, when a bank makes a loan, it must have financing strategy that provides an acceptable level of certainty about continuous access to funds at a cost that is less than the interest rate it can charge on the loan. Stage 4, which is the final stage of product design control cycle, gather and monitor experience. We can divide this stage into 4 categories, which is pricing, next product design control cycle, market research in response to changes in regulation or law changes. This stage is important for any product, but it is particularly important for financial products such as insurance. Firstly, pricing. It is important to regulate the price to make sure it is acceptable to all parties. Better price would lead to sales volume peak. Other than that, next product design cycle. This action is important because it can identify the need for a new modified product, which we can reduce the cost, regulate the price, and create a better design that can be accepted by the user. Market research. Market research allows a company to discover the target market and get opinions and other feedback from consumers about their interest in the product or service. It is important as we should find the opportunity for the best time to sell the product at the best time and high demand from the consumer. The last one, which is response to changes in regulation or law changes. We should know and understand any legislation, regulation, code of conduct and professional standard that apply to the product. This is because we want to prevent from the loss because of legal action that being taken because of your product does not meet the requirement for it to be legalized. Practical implication for actuaries. There are 4 practical implication for actuaries. The first one, give the provider some direction which it is important to avoid the insured from getting big loss. Other than that, drafting illustrative material also one of their practical which can point out the direction for the insured. Next, provide accurate information. This practical is important as it can use to provide better predicted outcome. Lastly, document the work carried out. By documenting the work, the
key learning points of this topic is product design is a cycle within a cycle. Second, new product can be identified. Third, product strategy is critical to the success of product. Fourth, project management helps to achieve successful product design. Fifth, competition, marketplace and stakeholders' expectation must be considered. Next, the product must be manufactured and distributed once it has been designed. Lastly, product must be administer, manage, liabilities, gather and analyze once the product is sold. Product design is a cycle within a cycle where a company identify the need for a new product and develop a product synergy. Then, they will develop the product, manufacture and distribute the product, gather and monitor experience and repeat the cycle again. In a product design strategy, a company must consider company's distribution method, the risks of the product, mitigation techniques, and resources necessary to create the product. Project management helps in product design by developing expectations and objectives, establishing financial objectives, timelines and responsibilities, and facilitating communication. Provider, customers, distributors, and regulators are considered as stakeholders. The product must be distributed once it has been designed and manufactured, which involves distributing using acceptable sales material and contract documentation, as well as selecting appropriate risks.
Thanks for watching!